So like I was just talking to another post-exit founder that company owes him $200 million.
Holy cow.
Hey, co-founders, welcome to Made It with Connor Tompkins, a podcast where we meet with badass entrepreneurs who've successfully exited their companies, discussing everything from the wins and losses of entrepreneurship to the next steps after the exit. To not miss out on these exciting stories, be sure to subscribe wherever you get podcasts. Let's dive in.
Hey everyone, welcome to the Made It podcast. We interview inventors, creators, and entrepreneurs that are helping shape the world that we live in. I am super excited to welcome Jason Kirby. He is a serial entrepreneur, founder and CRO of Liquid Sky, which sold to Walmart and also helped raise money for Generation eSports, which is a really cool concept that we'll get into in just a second. Now you can find him at Thunder VC and the podcast Funding Demystified. So Jason, welcome to the show.
Thanks for having me on the show. Appreciate it.
I'm really excited to talk to you about a few things, but one is you had your head down as a leader of quite a few companies, and then you had to pivot to post-exit life, and you had to figure out what it's like to be a public-facing CEO or founder, and you now have a podcast out. What has that transition been like for you?
I would definitely rephrase it in the sense that I don't have to be public, but I chose to be public. One, coming after exiting my previous companies, I was just managing teams, growing teams, managing people, setting vision, closing deals. There was just so much in the business, and that's how those businesses needed to thrive. Kind of leaving that world and starting Thunder, I have a genuine passion for founders in the positions that they're in, and just it's incredibly hard being a founder.
Tell me a little bit about what Thunder does, right? At what point should someone reach out to Thunder?
So someone should reach out to Thunder when they're thinking that they need capital or are looking to exit. So to kind of give a quick summary, we're an investment bank at our core. And I chose to build an investment bank and kind of do what we do, mainly because I had investment banks when I was running my previous companies, and they didn't deliver what I was hoping they would. And the concept of what they're capable of as investment bankers is so valuable, but often at smaller stage stuff like sub 100 million kind of transactions, you just don't get the level of expertise and guidance you need as a founder. And there's just so many deals happening in like the $5 to $100 million range out there that these founders are not getting the coaching and the advisory that they deserve when navigating these very complex and often first time ever and one time ever situations.
It's interesting to me because whenever you work with an investment bank or a private equity firm, they always talk about, we have this network and we'll help you get to the next stage. But essentially they're running their part of the play, whether it's like a roll up or an investment, and the portfolio doesn't always talk to each other, right? Like they're kind of islands essentially inside this ecosystem. So that makes complete sense to me. How do you change that?
Not a lot of investment bankers that were founders previously outside of founding their investment bank baby. And so they don't really understand what founders go through and what they're dealing with on a regular basis and the challenges that they're facing. Often most investment bankers are like, I know Bob and Mike and John, that I'll send them your deal, and if they invest, I want my cut. Or if they buy you, that's my cut. But there's like kind of smaller deals, you just don't really get the support that you need as a founder to kind of know what's right for you. Like, hey, you want to sell your company, but did you set up all your taxes, your QSBS, the company in a way that will give you the best tax advantage outcome that would probably give this highest yield possible out of any effort that you put forth?
You don't really know what's out there. I mean, I didn't do QSBS for any of my deals. I really wish I did. What is QSBS?
So QSBS is a tax advantage solution for founders that start a company. And this doesn't have to be just founders. This is basically like all early investors, kind of those founding shares or like early investment shares that I'm not a CPA, not a tax lawyer, but effectively it's if you hold a C Corp, and it's usually always US C Corps that this qualifies for. If you hold shares over a certain period of time, you basically don't pay taxes on the first $10 million of proceeds or profit.
What's crazy about this is that you can do QSBS like stacking. So like it could be for you or your spouse, or if you have a trust, you could do one for each of your kids. And so that's 10 million for each of them, which is a lot of money. Which is
a very common conversation amongst post-exit founders. That the first deal they did, they never knew. And the second deal is like, I'm not making that mistake again. They do their 83B election and they gift shares across, multiple family members and trusts so that they can do the, as you mentioned, QSBS stacking. And it doesn't cost much. It's like, and it's smart to do if you just do every business that way at the very beginning. If it's a big success, it's awesome. And if it's not, you didn't really lose much in the beginning.
Do you feel like there's any other tidbits that come out whenever you're working with these founders? Because you have a community that's pretty large, right?
Yeah. So we have a newsletter, about 12,000 founders now, I think. So good little size. There's obviously much bigger ones out there, but steadily growing. But yeah, the common things that I hear most from people looking for help or guidance is, in most cases, they went out on their own and they didn't strike gold. They went out trying to raise money or sell the company, and it didn't go the way they thought it was. And unfortunately, that's not the best time to bring in help, because either they've ran out of money or they're in a tough spot, and there's not much else that could be done at that point outside of maybe fire a sale, which is not something that we particularly help with. But when we catch just good entrepreneurs doing good things and building good businesses, we just try to make sure they understand what the current market climate is. So many founders are usually a couple of years behind on what's going on in the capital markets because it's not their core competency. It's not what they should know. It doesn't affect their business day to day, but when it comes to raising capital or selling a company, and they're like, oh, we should be able to sell for 20x revenue. And you're like,
not quite.
Sharing that education with founders, again, planting seeds. And the unique thing about founders is, in most cases, they're DIYers. They do everything themselves. They have to figure out everything themselves. And respecting that and acknowledging that and just giving them the tools and knowledge and connections to do what they do best and allow them to kind of grow and develop as leaders is one of the unique approaches that we have in terms of helping them get to that next milestone. Because that's really what it's about. It's like, how do they get to that next milestone, whether it's raising capital, whether it's debt or equity, or exiting the company through a strategic or financial exit. Those are the kind of core areas that I focus on now, because from my personal background, those are things that I was doing as operator and founder. And there's just so many lessons learned that could be shared in advance, kind of like see around the corner before you even get to the corner. I think like that's something that helps founders plan and strategize how they run their business.
I think that makes a lot of sense. How did you get this off the ground? How did you get the first subscribers to your newsletter, and how did you bring them in?
So originally launched the company after I left Generation eSports, partnered with my friends over at Interplay Ventures, Mark Peter Davis and Kevin Tung there. Known them for a long time, wanted to collaborate on something. So we decided to launch, Thunder out of the Interplay ecosystem. And the reason I chose to do that is, I've been an operator for so long, and I've been in these transactions, I've done deals, I've been investing and all this stuff. But I realized, at least for my previous businesses, before I got into the venture-backed world, like doing stuff alone is not as nearly as much fun or sustainable. And I wanted like a collaborative ecosystem. And so I launched it through them. And then the original idea was, providing tools to help navigate the ecosystem. And so we built like an algorithm that identifies who has a higher probability of investing in who, and providing that data to founders to be able to know who they should be chasing when it comes to building relationships with investors. But we quickly realized that that's not a sustainable business in and of itself. And I found myself just giving away my time and resources. And ultimately people really wanted that. And that was the monetizable piece. So I was like, okay, let's maybe drop the prioritization of our SaaS model, and let's focus really on being that advisor and consultant and banker that founders are looking for. And so I decided to go and do what I thought would be a better business model, as opposed to like charging large upfront fees as like a typical like agency or consultancy or management firm. We're doing a success-based model, but in order to do that, we had to be registered with FINRA, become a broker-dealer, all that stuff. So got all that squared away and got those boxes checked so we can legally represent ourselves and take a success fee to kind of put our money where our mouth is.
I'm seeing a lot more people do like email newsletters and spinning up communities. And what are some lessons learned that you have from having this many people inside a single like online space?
I feel that's the future of direct engagement with building brands and building companies without a a brand or persona that people can learn from and engage with. It's just so hard to get in front of people and stay top of mind. And I was spending so much time, I was meeting probably a couple dozen people a week in the early days of Thunder, just building my network, building my connections. The problem with my business, though, is when I sign a client, they're, whatever, a B2B prop tech SaaS company. And I've been talking to a million different investors, but only like 5 are relevant for that particular deal. How do I just stay top of mind? How do I keep building relationships? How do I support these pre-seed founders that will never be a formal client of mine, or at least anytime soon? How do I continue to nurture them and support them and be top of mind for when the opportunity does come, that hopefully our content, resources, and things that we put out there were helpful to them, to where they can come back to us when the time is right. So when they've accomplished certain steps, and it's nice. We've been doing this for about the newsletter is about, I think we're on episode issue 65, so it's only like a year and a quarter long. So it's not very old. And we the podcast is, I think, we just announced episode 33 today. That's about half a year, 6-7 months. So there's so much to kind of commit up front. It's just now starting to really like pay off. Like people we spoke to a year ago are coming back. So that's kind of been, I think, the most rewarding part, is just give. And then eventually things come back, which we're just now starting to see the fruits of it. So it's definitely a long game for us.
We were talking to, earlier on the podcast, we had Aaron White, who did Profit Well and Blissery, and we were talking about how these like paid communities are almost like the new social networks, because they're very niche focused. They are very intentional about what reason they have bringing people together. And you're seeing like these platforms like Circle and Mighty and School, that recent investment, like kind of take off and grow. And I'm a little curious, because on one hand, I could see saturation happening and being like, I don't need to be a part of 20 different communities. But on the other hand, we both are a part of these like networks and these communities where we get a lot of benefit from, and we are probably spending more time on these communities than we are on like Instagram. And so there's something to it.
I spend more time scrolling through my private communities than I do Instagram.
Hey, podcast listeners, we are currently looking for sponsors for this podcast. If you guys are looking to connect with other business owners that are scaling and growing their company, and you guys are interested in a spot on this podcast, we're looking for you. So reach out to connortompkeys.com or operatorequity.com, and we're glad to help set you guys up with a spot on this podcast. All right. Cheers. Back to the pod. What are some of the things that you hope Thunder will accomplish? Do you have some aspirations coming around the bend?
Ultimately, I see us just continuing to scale up our client base and being able to bring in and attract amazing founders that are doing amazing things and adding immense value to them in their transactions. I think that's the given. That's like what must happen for us to exist, because if we don't deliver value, no one's going to work with us. But what I think is unique about us, and something that I try to set the foundation for as early as possible, is creating like an investment banking opportunity with a kind of venture startup culture. If you've met investment bankers, typically you have like the 90% of everyone that's had investment banking on their resume drop out, because it's very much like a hazing culture of just like, the bottom, analysts and associates just get pummeled with all the bullshit work, and the NDs at the top are the ones just doing all the cool, fun stuff, the relationship building and the strategy and all that stuff. And there's just so much, some of the best talent, the smartest people in this country go into investment banking for the money, but often find themselves getting burnt out, doing volunteer work to be able to live their life.
They join the Peace Corps.
Exactly. And no fault to their own. It's the way the culture is in typical investment banks. It's pretty harsh and unsustainable for a lot of people that don't have a certain personality. And I see an opportunity, because a lot of these investment bankers want to get into venture, because venture is perceived as sexy, cool, and very different from traditional finance. But it's also not a very sustainable business model for most venture funds. We can go on that in a separate, conversation in terms of how they perform. But so my vision is, investment banking is not a tech back. We're not a venture backable company ourselves. So we're a very linear growth, talent focused team. So it's how do we get the best talent and retain and attract the most amazing people that can then provide as much, value as we possibly can to our clients. And I think that's going to be our unique edge, is having a public facing, brand where we have a unique perspective that we're actually, publicly creating content and adding value to the broader good, but also having that kind of more casual start. That's what I would love to change and kind of disrupt and just create a different type of investment bank that I think is more aligned with our generation of millennials and Gen Z that would rather do business with us than, say, our competitors or the current incumbents.
I almost feel like traditional PE is an extension of like the leverage buyout kind of culture that was in the 90s. And then you're figuring out how to structure these deals in a way that are creative. But I think that there's some ramifications if most of the buyers in the market are these type of financial buyers. So do you feel like that's your play, is that you're just providing this alternative to whenever they have like 5 options and 4 of them are financial, they're like, oh, this is the way I want to go,
I think we still have to check all the boxes that come with what the execution of the work, like models still have to be built, practicality says, but you can be cool and fun, but like, you still got to get the work done. Still got to know the numbers and know what's marketable. And ultimately like the buyer, whether that's the acquisition, the acquirer, or the investor who's, buying the equity in the company, it's about being relevant. And I feel like there's so much time wasted chasing money for the sake that it's money and not realizing what's on the other side of that in terms of, what are they actually putting money into? What are they actually investing in or acquiring? And seeking alignment and compatibility, with them for the very get-go and filtering that as early as possible. I feel so much of the capital game is who knows who and who likes who and who owes a buddy a favor. And albeit notorious for still getting deals done and will probably forever always be, whether there's merit to the deal or not. But I think there's definitely an opportunity to cut through noise and allow founders that if they're going to put the effort into building a relationship with a potential investor or acquirer, like at least make sure that the outcome is viable. Like somebody founder, like a CPG founder talking to a B2B SaaS investor because their buddy knows a buddy, and I'm just like, that's such a waste of time for everyone involved, but everyone's got this like feeling that they have to take the meeting anyways because it was referred by someone they like or whatever. They didn't do their homework, but everyone's like pleasantries, like, oh yeah, no, but they're not honest with each other. That's the kind of stuff I hope to eliminate. That's what our tools at Thunder.vc hopefully help founders with, is, narrow your focus and, build the right relationships.
I do feel like with the startup culture, the way it is now, there's a lot of emphasis on raising traditional VC capital, a lot of emphasis on pitching and focusing on being the next big thing and having a big enough a total addressable market and being new, that you're just adding on levels of risk for a first-time founder. So I don't feel like that's necessarily the best way to go. Well, not all the time. I guess I should add that caveat, because I think that there's room to buy existing businesses that have cash flow, or maybe do something that's already proven out and then figure out how to innovate on it once you're inside.
It's funny you bring that up. So when I left Generation eSports, that's actually what I was focused on. I was actually focused on more acquiring a company versus starting a company. Timing wise, had I been in the situation I was then, but in now's market, I probably would have ended up doing that. I probably would have been more acquiring a company as opposed to starting something. But the multiple, I was, it's 2021 peak market. Every business was selling for like 9, 10, 12, 15x, ARR. And I wanted to do the deal by myself. I was like, I don't think that's doable. And like everything I went and try to, everyone's ego was just so through the roof. I was just like, I think I'm better off maybe starting from something from scratch than trying to buy a business in this market, not knowing that, it was going to collapse in 9 months. But that was something that I think is more and more of a common topic these days, especially a lot more content out these days about that strategy, which I think is opening up a lot of people's eyes.
Yeah, I think it's healthy. I mean, if you have so many people that aren't able to sell their business in the first place, or they don't know how, or they don't feel comfortable, getting more buyers inside the market that might be open to continuing the company. It's better for employment. It's better for innovation. Once they cut their teeth, they're more likely to continue to start businesses. So it's probably a good thing to encourage. If you're interested, go start a business, guys. Go find a business to buy. So Generation Esports is an interesting concept. Essentially, you're bringing esports into schools. Do you feel like esport athletes are going to be the jocks of 2020?
I wouldn't say the jocks. I think jocks has a very specific definition or identity. I think they are. I think what appealed to me about Generation Esports and what we did there was we were taking, what would in most cases the bottom performers in schools, the kids that were, not feeling that they belong. They often found their solitude in their happy place of like playing games online, but they're playing online in the open toxic internet down in their basement with no adult supervision. Who knows what's happening. And we kind of gave them the path to get engaged on campus, doing something they love that ultimately surrounded them by like-minded peers and adult supervision working towards a common goal. And that was just such an inspiring thing to work on, and hearing these kids like, I was dropping out of high school and now I'm like graduating with a 3-point, GPA, and I was a team captain. And what's also so it was like the best part of the job. What was also cool was just seeing the diversity on the teams.
The different types of stereotypes that you see in like the Mean Girls play.
It's all the stereotypes. But when you go to the esports, it's every kid from every group, from every background, from every gender identity to every, race to every shape and size. And what was also cool is like some just plain suck at video games. Like, if you don't have the skill, you don't have the skill, you don't train. Like, but they were learning other skills. Like, they were the social media manager. They were the manager of the team or the whatever. It's just these kids were filling roles to feel like they belong and commit to a group. And it was just really cool to see. So I think the world will be a better place accepting structured esports in the classroom, and give more kids a path to get involved on campus, which, whatever it is kids get involved in, once they get involved, the probability of their outcomes are far superior than they are if they don't get involved.
I agree with you. This is something that needs to exist and it needs to be out there. Did you ever do LAN parties, like where you would invite friends over?
Well, no, I didn't have the means to host LAN parties myself. Growing up, I would usually play. There was like a internet cafe that was like, the strip mall down the street that we would all go to and play Counter-Strike, or back then like Red Alert or something. My internet sucked as a kid, so I couldn't really play. I was playing on dial-up. My friends were playing on cable.
You get headshot, and you're like, "Where did that come from?"
It's actually, it's something that always bothered me because I was always like a generation behind on the technology and the internet between amongst my friends. So I was always like trying to like keep up, and I never could.
I feel like because of where the technology was at then, you had to have a LAN to like bring people together, right? And then technology got so great, I'm like, I can be wherever, it doesn't matter, and I can play. And so this is almost like you almost see like the pendulum, like just moving back and forth, right? And this is like, hey, we're gonna come back together again. It was actually a good idea. We can have leadership opportunities for the kids inside schools. Are you seeing a lot more schools open up computer labs to kind of launch these type of programs?
Well, we opened up 25 ourselves. We landed a huge sponsorship while I was there, and shortly before I left, we had deployed 25 esports labs across 25 schools across 25 states in 60 days. A lot more are investing, because like typical computer lab, in the library, and everyone's got their phone, which is more powerful than the whole computer sitting in the library. But there are more and more investments going into the concept of like gaming compatible computers. It's again, they need an esports program, they need justification, and that's kind of what Generation Esports was providing to come. They were providing curriculum, providing structure, to be able to kind of scale those into more and more schools.
We got in trouble because they didn't want like games on our computers. I remember that. And we got in trouble because we had a folder called Math is Fun that was on like the school district like server. And Yeah, it was just all video games inside of it, and they couldn't figure out how to get it off.
One of the things in the early days of Generation Esports, I went to one of the campuses and met with a bunch of teachers and principals and superintendents. And one of the superintendents at one of the best performing schools in our league was, presenting, and he was just like, I hate video games. I banned video games. I was adamant against it. And it wasn't until this kid, one of the kids that was, on the team, he came and asked for permission. I said no. He went behind my back and he built this incredible, thing that I wasn't made aware of until we won a championship.
That's amazing. Isn't that awesome?
Isn't that right? And he shares this whole story of how he was wrong and like how he learned, and now he pumps money into it and provides all this support for the kids because he saw what was his kind of lower performing students that were, not as engaged, lower grades, lower attendance. And now they're on the complete opposite side of, some of the top performers on campus. And so that was something that I thought was incredibly empowering and powerful, for one, to admit you're wrong, and two, to then support moving forward and to be now a voice among, he goes to conferences now and talks about it.
I wanted to talk to you about your other company that you went through an exit. So how did you sell Liquid Sky to Walmart?
This started out of my partner's, parents' house in Tarrytown, New York. We're building this technology that is making Microsoft, Google, Amazon, all envious of how we're basically splitting GPU compute. The product itself was an interactive content delivery network. We were virtualizing GPUs and splitting and sharing resources to enable a more profitable unit economic way of sharing, GPU resources, which our first use case was gaming. So play any game on any device by accessing your cloud gaming PC. That was kind of the offering. So we grew that to about 1.5 million users. Samsung was our largest investor, and Samsung actually was supposed to buy us. And so the real story is Walmart connects to us about a month before closing with Samsung. And they just kind of poke. It's like, hey, looks like you're doing, someone that's, mid-level, not, it's not like the CEO of Walmart's reaching out. We completely ignore them because we know that we just can't rock the boat. Okay, we're about to sell to Samsung. Walmart's probably not going to change anything. Let's just stay the course. That deal fell through the morning of close. Talk about, I've had term sheets pulled. I've had all kinds of things happen to me in my life. That was probably the most painful, was when we get a text at like 2 a.m. saying that, Samsung's out.
What was the reason for that? Did they say?
Oh, yeah. Oh, it's very public worldwide. So basically the CEO went to jail.
The CEO of Samsung or Liquid Sky?
Samsung.
Okay.
Samsung CEO went to jail for political corruption in 2017. The new CEO steps in, and his first day of signature authority is the day we're supposed to close. And his thing is, I don't know what's corrupt, what's not corrupt, so I'm killing every deal on the table, no matter what it is. We were one of those many deals. We had bottles of champagne ordered. We had buses ready to pick up the team members taken to the office. We had all the contracts ready to printed and ready to issue to all our employees. We had asked our team to show up at 9 a.m. sharp, which, we never did. No one ever showed up at 9 a.m. And and then when they all show up, I tell the team, I was like, what do I tell the team? Because they don't know. They had no idea we're getting acquired. Only 5 people out of 40 people knew that we were in acquisition talks with Samsung. And outside of, me and my founder, that we were the only ones that really knew all the details of the board. And I just say, we're going to have an epic holiday party, everyone. This is December.
You're just we appreciate you guys. Surprise champagne. Yeah, let's go.
Exactly. We're going to have a great party, everyone. This is going to be so much fun. And
they're like, why is Jason crying inside his champagne?
Why should I think he's dead inside? So that was just what the hell do you do? Just how do you handle that? Because legally we can't tell them. 2, technically the deal's not dead. It's just on pawns. But it's a pretty clear sign things aren't going in the right direction. Strategy's going to change. The deal's dead. So we're pretty butthurt, pretty upset. Don't know what to do. We had to do some layoffs. But the funny thing was, the next day we take that call to Walmart. And we meet with some higher ups at Walmart. We just start nurturing the relationship. The idea was to bring Walmart gaming to their ecosystem, compete with Prime and like have more of a digital offering and stuff like that. So it was like, oh man, this actually makes a lot of sense. I think there's actually a clearer path to market and actual revenue with Walmart than maybe Samsung. So I was like, all right, let's keep going down this path. It's almost exactly a year later, we closed the deal with Walmart. There's all kinds of ups and downs in that process too. It was not a good year under any circumstances. It was hell. All kinds of moments where we think we might lose it, or we're like balancing this house of cards, like, oh no. Okay, they're like, and again, no one on the team knows. So when you're making decisions as a leader, and you're like, I know you want to do this with the product, and it's a great idea, but you can't. Why? Jason, it doesn't make any sense. So
it's hard because that's a full-time job for you, right? You're going out and you're running this process, and people are like, "What's up with Jason? Like he's not acting normal, right?"
It was tough, and also just keeping other parties. Like Walmart was the main attraction, but we were teasing a bunch of other relationships. To one, keep Walmart honest. That's something that all founders should try to do. It's like once you think you have someone in bed with you to do a deal, as much as you have high, faith in them and that relationship or whatever, it's good to have a couple side pieces. have some options, professionally speaking.
Professional off-ramps.
Yeah, some so we're talking to Verizon, we're talking to LG, we're talking to some other big players that, could potentially, be seen as a threat to Walmart so that they would, amplify, kind of put a fire under their butt to move quicker. And that's something that every founder should try to do. Like, don't just, even with investors and VCs, like the what happens when you have one term sheet versus two, it's like an exponential difference in conversation, when you have two options on the table. So always find a way to put options on the table and do whatever you can to make sure those options are respectful to all parties, but, that you have options.
Were you running a competitive process with a banker and broker, like guiding each step, or were you figuring out how to do this as an entrepreneur?
We were figuring it out. So Ian and myself, I would say I got to give a lot of credit to Ian on maintaining that, because I was actually in the opposite camp. I was like, we're going to Walmart. Why are we wasting our time with Verizon? They're like giving us the runaround. It's taking forever. And he was kind of adamant on keeping that back and forth going. Our banker was useless, in my opinion. He was more of an overglorified babysitter getting paid extravagantly well for what little he did. He was supposed to be an intermediary, but it was ultimately the board and us doing all the work. Hence kind of why I jumped into this. Like, there are definitely good bankers out there, but it was not the best experience for us. So it was, all that work was on us while still making sure, again, one of the options that we had was to continue without the acquisition, or at least giving that perception that we could. And so that's always like the most important chip to have in any negotiation is have like, hey, we're profitable, we can keep going, or hey, we have an investor and they're going to back us, or hey, we got two people that want to acquire us, and like that. And then they always want you to get under exclusivity, but you need to make sure you have certain precautions and protections in place. Once you sign a term sheet, you typically have to go dark. You can't engage with other people. It's basically a blind trust in some cases, but there's certain things that you can do to hold the other side accountable that either create a breakup fee or, hold them to be committed to the outcome. Because the worst thing that happens is you go full blind trust into it, and then you're out of money and the deal's supposed to close, and they're like, we changed your mind. We want to buy you for half off.
Yeah. And then from there, your other buyers are like, what's happening? We haven't heard from them in a while.
And you can't talk. The last thing you want to do is expose yourself to liability in this process. That's why having a great lawyer, great advisor to kind of navigate walking on eggshells throughout this process is incredibly delicate. There's just so many points of exposure that founders are just not aware of that come up. Some deals smooth, easy, clean, everything's perfect and rosy, but that's 1%, and the other 99% of deals that get done.
I was like, what deals are you looking at?
Exactly. It's just like there's all, because like when we get into like the post-exit founders, like everyone just likes to glaze over, like, oh yeah, I'm sold out. Yeah, like, but if you actually poke, like, oh yeah, no, this guy screwed us, this person did that. Like every deal is always messy.
We had a good banker/broker. So it helped with our process because we had some partnership stuff we had to navigate. We had to kind of keep everyone in lockstep, keep multiple parties moving forward. But I know that's not like often the case. And I interviewed like 22, 23 people to try to find the right banker or broker. And
That's good advice.
yeah, that was painful.
Yeah.
If you guys are considering doing this, what I did is I built a SIM, like a confidential information memorandum, before working with a banker and broker. And then I did like a BCC to bankers and brokers saying, here's who I am. Here's what I'm interested in doing. Here's a SIM. If you're interested, sign this NDA and let's talk. And that was enough for us.
That's actually a pretty good idea. I would say that is a great way to kind of attract, run a process to get the right banker. Because that's the other issue is depending on your transaction size, a lot of bankers just aren't interested, if it's on the smaller side. So, it's how do you show them that you're buttoned up and you're not going to be a pain in their ass and you're actually going to, have an outcome. Because again, it's a risk. Any banker working on a success fee, they want to make sure it's actually going to sell.
Yeah, it's a risk on their side. It's a risk on ours, right? And on my end, if they didn't read the SIM and they're asking me the wrong questions, I'm not going to go with that banker or broker. So it kind of works out either way. Jason, so because Walmart is public, can you talk about what that purchase amount was and what that was like?
The data is never publicly released, the actual numbers. So like on a public podcast, I can't share. The amount was unfortunately less than what Samsung was coming in at. And for obvious reasons, like, we had far less cash and our options were right. We had options, we were able to get the deal done, but it wasn't as attractive because everything was up and to the right, perfect for Samsung. But, deal blows up. We had a small breakout fee, but it kind of messed things up a little bit. Everyone made money, which was great. So it was, some of our investors made I think it was like a 10 to 15x in 3 years. So, pretty solid outcome. But, our later investors, the ones that kind of, I would say, made it so me and some of the, founders and our partners employees didn't get as much, because of like press and warrants that came in that last round to kind of fund us through to the acquisition. So that's something that is very much a reality of dealing with those complexities of, repricing, getting the cash in the door to make sure we have the optionality, but, paying to play. And so that's something that we learned a lot from, and, a lot of valuable experience from that process.
So that's something that's kind of tricky to navigate. So like you have a potential buyer, you need a bridge in between where you are in that round. And essentially their preference gives them a spot in the waterfall, and it kind of cuts you off to the side. But on the other side, you can negotiate like a bonus for that transaction to go through, and maybe try to figure out how the founding team or the employees can possibly kind of recover some of that.
So that's what we had. We had like golden parachutes for key members to kind of inflate what the team will get. So that kind of like made it a little bit more palpable, but it wasn't of, substantial value. And then one of the things that I think is important when you're dealing with like a real transaction and it's imminent and something's coming up, the founders should really have their own representation at the table as well. And I think that's something that is not advised to them by their investors or their board, because it's technically, they're going to be potentially negotiating against each other. But just given fiduciary responsibility that a founder has to its board and shareholders, there's certain things that you could be exposed to from a liability perspective that you're going to want someone on your side on the legal representation side of things. Because your lawyer that your company hires has a responsibility to the company and shareholders, not to you as a founder.
It's also true for your broker or banker, right? Because they want the deal to go through, and they're like, Jason or Tom is being hard, and they're like, just think about the big picture. Think about the bigger pie, right? And you're like, well, I'm going to be giving 2 years of my life, probably in transition or something like that.
It's so important to kind of know who's incentivized by what at the table and give yourself the proper protection as a founder. Just have that lawyer. And it's not like they're coming to every meeting. It's just like someone that you can confide in that has a legal and fiduciary responsibility to you to give you the best potential outcome. That could be just negotiating your comp package post-exit. with the acquiring company. It could be, reworking some of the terms to make sure that you get paid out properly. If you have an earnouts are one of the biggest reasons for disputes and lawsuits. Like if there's some kind of performance element of how you get paid. Like I was just talking to another post-exit founder that company owes him $200 million.
Holy cow.
It's just like,
and they're like, can we finance this, or actually like, can we walk this?
But he has that as an option to fight for because he had the proper representation to defend him. And so it's just something to think about when you're doing a deal is, you got to have good lawyers, transactional lawyers for the transaction, but you might want to look at hiring another firm or another individual to be on your side as the founder.
You should probably bring on some other entrepreneurs that can also help you say, like, this is normal, this is middle of the road, this is not. Or here's some questions that you should ask your lawyer, or even vet the lawyer. There's been a couple times when I'm helping an entrepreneur go through the exit process, and I'm meeting their lawyer that's going to take them through the process, and they're talking about the transactions that they've done, and it's a very small number, and you're like, oh, well, or they're not using the terms correctly, they're not the right person. And so having another entrepreneur that can either recommend you to the right team on the accounting side and the tax advice side and the legal side, connect you to other folks. It's helpful.
And that's the importance of when you're kind of raising that early capital, building a strong angel group, people that are actually invested in you from the early days and are there to kind of support you. Like, but hopefully that's the people you call when this time comes. Because one, they're incentivized for a good outcome because, hopefully they were an investor and they get, something out of it. But it's just, I think the moral of the story is, surround yourself with people that can help you see around the corner before you're there. So before you get to that corner, you can make sure you actually want to be at that corner and know what your options are going to happen when you get it.
Hey, podcast listeners. 8 years ago, I started a company called Support Ninja. It's an international hiring, training, managing, outsourcing company to help you find the best talent anywhere. If you guys are interested in hiring international talent, check out supportninja.com. Cheers.
Jason, I wanted to ask you about these kind of like one-person VC firms that are popping up. What do you know about them? Because I keep on seeing some people on like TikTok that are running like they spun up their own fund. They're investing in these different companies. They're about to raise their next fund. Are you seeing this more often?
100%, yeah. So they're called solo GPs. It's accessible due to all the technology that's available today. So like, AngelList, Carta, a bunch of others. They're making it so cost effective to spit out a fund that you could raise a $10 million fund and function. Whereas like before, all your management fees would be going to legal if you raised a $10 million fund. So I think there's just going to be a larger demand or a larger supply of solo GPs because when you think about it, it's fun. You spend your career, building amazing relationships with amazing people and being the hot girl at the party that everyone wants to come to because you have money to deploy. And so you get all this like kind of attention and opportunities. So I think there's a lot of appeal to start a fund now. The actual raising the money for your fund is obviously the much harder part of building those relationships with LPs. So, the ones that have the relationships, that have the platform to be able to raise the money. And it's, fun one. Fun too, like to have a partner and be a $10 million fund, you're splitting economics on a $200K management fee, like not very sustainable.
Yeah, and also understand what makes a good founder or a good founding team or an industry.
As a solo GP, like the whole narrative is like getting into the deal. I have access to the best founders. I have access to this network. I have my edge, and that you can't raise money without an edge. And the one thing I see as a problem is no one really talks about like portfolio construction, unless it's like a more senior fund that's raised a couple of funds that are talking to real liquidity providers like real LPs. Limited partners. And I think there could be a big issue, especially the ones that started like 2021, 2022 that deployed a lot of capital early in their fund one, fund two. They're probably default dead now. But that's something that I always kind of challenge people on is like, what's the path out? What's the path to liquidity? Because at the end of the day, backing a GP, like I like solo GPs. I think they're great people. They can make decisions on their own. But it's also, it could be a blessing or a curse without the proper infrastructure. So it's kind of a, up in the air. But again, a lot of LPs like early funds, small funds, because they typically have the outsized returns. It's easier to return a $10 million fund than a $1 billion fund.
I think this is interesting because I saw two different graphs. So the first graph was showing how smaller VC firms, like kind of like these boutiques, sometimes have bigger, better returns than some of the larger firms. And so I need to find that graph. And then the other graph was looking at the top 20 investors and compared to the baseline performance, and how solo capitalists or these solo GPs are kind of gaining in the top 20 list against traditional VC firms.
I think the solo GP, again, it's all about the smaller funds have a higher probability of returning the fund. So it's like, it's a lot easier to get a 5x fund, as far as like DPI back to investors. When you raised a $10 million fund, you're only returning $50 million. Now, there's a lot of those in the graveyard that return very little and whatnot, and those don't ever show up in the graphs because they're just kind of cast aside as bottom quartile. But those funds that do deliver those high returns, like when you think about it, you raise a $500 million fund, like that's just way harder to give, to return that, because it's such a hard strategy to deploy that much capital in venture in particular. And to have outsized returns and not have any losses, it just becomes a more of a financial engineering strategy and portfolio construction strategy to give, reliable returns. Maybe it's a 10 to 20% IRR, which, is definitely better than zero, but, not necessarily what you want to lock up your capital for 10 years for. So I think that's something that we'll continue to see always room for emerging managers. It's just, do they already have the network? Like that's, I think, the big issue. If you don't have the network before you start as a solo GP, it's going to be incredibly difficult to, one, raise the money, and then two, have success. So I think that's the one disadvantage for a lot of solo emerging fund managers.
I think that makes sense. So Jason, that's the pod. Where should people find you?
You can find me at thunder.vc. It's our website. Feel free to leverage our tools to find which investors you should be connecting with. It's completely free. And then you can also check out our newsletter at join.thunder.vc. And then LinkedIn is where I spend most of my time. I'll probably never get as engaged as I should on X, but definitely more of a LinkedIn person. Feel free to reach out to me again at jason@thunder.vc if you have something interesting to say.
All right. Awesome. Guys, if you haven't already, please do subscribe. This is going to be on YouTube and cascaded across the different podcast network. And I'll include Jason's links below so you guys can check out some of the stuff that he's involved in. But guys, that's the show.
That wraps up today's episode. For more inspiring stories and valuable lessons from successful entrepreneurs, be sure to listen and subscribe wherever you get podcasts. Thanks for listening. Until next time, keep pushing boundaries and writing your next chapter.